Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, AI disruption sending shockwaves across Wall Street and heightening demands for halo stocks. We'll get into what they are and whether you should buy into the action. But let's begin with our expert panel and three things investors ought to be thinking out right now. On the Barron's Roundtable, my colleagues Josh Schafer, Megan Leonhardt, and Andrew Bary. Josh, so many headlines that could have moved the market this week. I don't know which ones did, which ones didn't, but in the end, the S&P was up about 1%.
Yeah, so you got a little bit of a rally, Jack. It seemed like it was maybe going to be a flat week, right? On Friday, you had the Supreme Court ruling against President Trump's tariffs. You had the market kind of go both ways on that on Friday. It went up, it went down, ended up closing higher. NASDAQ actually led this week, so you did see a little bit of a rotation back into tech. But if you zoom out here and think about the full year, there just hasn't been a lot of movement on the index. We've been waiting for S&P 500 7,000 for it feels like 2 months now, right? And there's just not a lot happening on an index level, but plenty of moves happening under the surface.
Yeah, I mean, what you're seeing is that some of the Mag 7 stocks, which have led the market the last few years, are actually a drag on the market this year. They're like flat to down. Microsoft and Amazon are down close to 10%. And with them being 35-ish% of the market, with them not moving or going down, it puts a damper on things.
Well, and you really need tech to start working, Andrew, right, if you're going to get the index to keep moving higher. So you've seen energy be a leader this year. Energy's up more than 20%. XLE having its best start to the year. Consumer staples also having its best start to the year on record. But what you have for an issue right now is just this software AI disruption problem. We're calling it a terminal value problem, right? How do you solve for where these earnings end up in 3 years, 5 years? You're not getting those answers right now in the market when you're just next quarter's earnings or even 2026 earnings.
Yeah, it's pretty hard to tell. This disruption, we think it might happen, but we don't know. I don't know that you'll get that question answered next week, but what will you be looking at? NVIDIA's earnings coming up.
Yeah, you have NVIDIA earnings coming out next week. But to the point of that question, Jack, I think perhaps even more important is earnings from the different software companies. You're going to get Salesforce earnings. You're going to get Snowflake earnings. What do those companies tell us about the future outlook? Can they tell us anything?
Yeah, I mean, expect them to downplay all the AI fears in no uncertain terms. We'll see if the market buys that, though.
Yeah, exactly. Megan, let's go to the big news. Josh referenced it, the tariffs decision. It really wasn't a big surprise, and frankly, nor was President Trump's response. But what were your big takeaways?
Well, I think bottom line is tariffs are still with us. I think that's the takeaway for investors right now, and that's probably why you didn't see the market, have a huge reaction, because it wasn't as big a surprise, and because we were expecting the White House response, which was the fact that, okay, we can't do the tariffs through this avenue, so we're going to turn around and, impose a 10% global tariff via this avenue. So we're playing a lot with the regulations and the laws on the books at this point. The White House is working, for a number of different outcomes, but it is one of those situations where consumers, if you are worried about the affordability issues, this doesn't solve it for you. Unfortunately, this is not going to drag inflation back down to 2%. It is something that's going to be with us. A lot of those supply chains, a lot of the price increases, those are already kind of baked in at this point.
So what I'm interested in is to see whether there will be a clawback. Will anybody have to give any money back? And if they did, does that make the deficit worse, or does it come into the economy and provide stimulus? What do you think?
Well, the court didn't provide a whole lot of answers to that question. So it will obviously go through the courts. It's going to take a really long time to sort this out. I think,
the checks are not in the mail.
Checks are not in the mail. Expectations are that we're going to see partial refunds, perhaps down the line. Big companies are probably going to be more beneficial than the small companies, unfortunately.
They got more accountants working on this.
They do.
GDP numbers are out this morning. What comes next?
So basically, we had GDP. It was 1.4%. It was a little bit lower than we expected in consensus, mostly because of that government shutdown. But what that does is it actually sets us up for a good Q1 rebound. And for 2026, expectations are for 2.1%, a little bit below than what the administration's expecting, but we'll see where we go from here. I don't think the tariffs are going to be as big of a story this year. Some of the uncertainty that the ruling does impose, probably not as big as that 2025 story. Things are looking a little bit more stable this year.
Well, sort of. I mean, that chart they just showed was pretty crazy with the up and down the GDP. I guess it levels out to a 2.2 number.
A lot of this is from that trade policy.
Yeah.
You have to remember, we've had huge gyrations with exports, imports, inventories, all of it. It makes the GDP math super fun these days, let me tell you.
Andrew, this week in Bears, we got a special section about alternative investments and some breaking news in the private credit area.
Yeah, I mean, private credit's been one of the hottest areas on Wall Street, and it's been a focus for the big alternative investment managers like Blackstone, Ares, Blue Owl, KKR. They've been packaging these private credit loans, which are high-rate loans to private companies yielding around 10%, to retail investors. A few $100 billion of these have been sold. Private funds, some of the public funds, and you're seeing some cracks. I mean, small cracks forming in the market and kind of rattling investors. And it's also hurt the stocks of these alt managers.
Yeah, this could be meaningful for even investors who aren't invested, both because of its effect on the market. And President Trump has told the DOL and the SEC to change regulations to make it easier for retirement investors to get involved in this. But one thing, Andrew, I think a lot of people don't, I have trouble understanding myself. What exactly happened this week?
Well, I mean, one of the big managers, Blue Owl, decided to sell about $1.4 billion of these private credit loans, and they decided to pay about $600 million back to the investors in one of their private funds. They spun that as being a positive. We got a good price. We're going to return cash. Investors saw the negative, which they're going to be suspending regular redemptions. And so that's prompted concerns that you're going to see money flowing out of this private credit from retail investors, which have been piling in. So that's basically the big concern right now.
We got to go real quick. Forced selling can mean opportunity. Do you see one here?
If you want to play it, you can buy the BDC ETF BIZD, ticker BIZD, yielding around 12%. The area is very depressed in the public markets right now. If you're also looking at some of the alt managers, if you like Blackstone, Ares, if you're interested in those.
Be a liquidity provider. All righty. Thanks, Andrew.